What if I told you that $100, the amount you might spend on a couple of dinners or a night out you'll forget by next week, could quietly turn into hundreds of thousands of dollars? Not through luck, not through some risky bet, just $100 a month invested and left alone. Most people never do this because they're convinced it's too small to matter. By the end of this video, you'll understand exactly why they're wrong. The lie about small money. The single biggest reason most people never build wealth is that they believe small amounts of money don't matter. 100 a month? That's nothing. I'll start when I have real money. It feels like common sense. And it's completely, mathematically wrong. Wealth is rarely built by large sums moving fast. It's built by small amounts moving consistently over a long time. The person who invests $100 a month for 30 years often ends up wealthier than the person who waits and tries to catch up later with much larger sums. The reason is one force: compound growth. How compounding works. Money in a jar just sits there. 100 stays 100. That's linear growth, slow and weak, but invested money earns a return. Then, that return also earns a return, and the returns on your returns start earning returns. It builds on itself faster and faster, like a snowball rolling downhill, picking up more snow the bigger it gets. At first, this looks boring. The difference is tiny for a year or two, which is exactly why most people quit. But compounding isn't a sprint, it's a slow burn that becomes a wildfire. The magic happens in years 15, 20, 25, and beyond, when the snowball is growing by more each year than you even contribute. The numbers that change everything. Let's use $100 a month at roughly a 10% average annual return, about what the broad stock market has averaged long term before inflation. This is an average, not a promise. Some years soar, some crash. After 10 years, you've put in $12,000. The account is worth around $20,000. After 20 years, you've put in $24,000. It's worth roughly $76,000. After 30 years, you've put in $36,000. It's worth about $228,000. After 40 years, you've put in just $48,000. It's worth around $630,000 from $100 a month. Notice, over 90% of that final wealth wasn't your contributions. It was compounding. Your money made money, and that money made more for decades. The cost of waiting. Two people invest $100 per month at the same return. One starts at 25 and invests 40 years. The other waits 10 years, starting at 35 for 30 years. The difference in contributions is only $12,000. But the first ends with around $630,000, the second with around $228,000. Waiting 10 years didn't cost $12,000. It cost roughly $400,000 of final wealth, because the years you lose are the most powerful ones, at the explosive end where the snowball is biggest. "I'll start later" is the most expensive sentence in personal finance. But $100 isn't enough. You're right. 100 a month is the floor, not the whole plan. Nobody stays there forever. You start at 100 because it's what you can manage today. As you earn more, you raise it. 100 becomes 200, then 500. Bump it over time, and you're looking at potentially 7 figures, built on habits you started when you had almost nothing. The 100 is the on-ramp. It builds the habit and puts time on your side while you grow into contributing more. Where the $100 actually goes. That return doesn't come from picking hot stocks or day trading. Most people who try that lose. The boring, historically reliable approach is broad, low-cost index funds, a single investment that owns tiny pieces of hundreds or thousands of companies at once. You're not betting on one company, you're betting the overall economy keeps growing over time, which historically it has. It's diversified, So one failure barely matters. It's low cost, so fees don't eat your returns, and it's automatic, removing the emotion that wrecks most investors. Many people hold these funds inside tax-advantaged accounts. The specific types depend on your country, so research yours. The real enemy is you. The math is simple. The hard part is behaving. Markets don't rise in a straight line. There will be crashes, scary headlines, years your account drops 20, 30, even 40%. The instinct to sell when it's scary is exactly backwards. It locks in losses and misses the recovery. Markets have always eventually recovered. The people who panicked and sold turned a temporary paper loss into a permanent one. The people who did nothing, who kept investing through the chaos, came out wealthier. When the market drops, your automatic 100 buys more shares on sale. Volatility isn't the strategy breaking, it's the price of admission for long-term returns. Dollar cost averaging. Investing the same amount every month, no matter what, is called dollar cost averaging. Nobody can reliably time the market, so stop trying. When prices are high, your 100 buys fewer shares. When low, it buys more. It averages out your price and removes the emotion. Automate it, then genuinely forget it. The best investors are often the ones who set it up and ignore it for years. About inflation. $630,000 in 40 years won't buy what it does today. Inflation erodes money over time. But even after inflation, that historical average leaves a real return of roughly 7% a year, which is genuine wealth in today's buying power. And inflation is the very reason you can't leave money in a savings account. Cash loses value every year, guaranteed. Investing isn't just how you grow wealth, it's how you protect it. What $100 really is. $100 a month is about $3 a day, a coffee, part of a delivery order, a couple of impulse buys you won't remember. You're not losing it. You're transferring it from a present self who'd barely notice to a future self who'll be profoundly grateful. Treat your future self like someone you love. And it's not really about the money, it's the habit. When you automate that investment, you stop being someone who wishes they were good with money and become someone who is an investor. A mediocre plan you stick to beats a perfect plan you never start. How to start this week. Pick your amount, 100 or less if that's what you can sustain. Open a low-cost investing account available where you live. Choose a simple, broad, diversified, low-cost fund. Automate a transfer right after payday so willpower never enters the equation. Then leave it alone. Don't panic, don't tinker, don't get clever. That's the whole thing. Its simplicity is exactly why it works and exactly why most people overlook it. Don't wait for a better time that never comes. Pick your amount and take the first real step this week. Not next month, not once things settle down. The smallest amount of money, started today and left to grow, might be the most powerful decision you'll ever make. See you in the next one.